Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, June 21st, 2022, and I'm pre-recording this Trading Places Live for just a bit later this morning. Currently, futures are actually pretty strong. They're off their best levels, but still pretty strong. Dow futures up 460. S&P 500 futures up 62. NASDAQ futures up 189. So on a percentage basis, all are up between about 1.5%, 1.7%. Crude oil prices up currently about 2% to a little over $110 a barrel. The U.S. 10-year Treasury yield up 5 basis points, 3.29%. That is still well off of the high from last week, which was up near almost to 350. But again, still at 329, much higher than what we have seen throughout much of this year as rates continue to climb. We've got inflation fears, not just fears, we've got inflation and those rising rates. We got a hawkish Fed. We've got crude oil prices still high at $110 a barrel. They did get up to 130, so they're off of that, but still relative to where we were when we started the year, much, much higher. We've got the ongoing war in Ukraine, Russia and Ukraine. So you got a lot going on. Many fear potentially a recession. We've been talking about that at Earnings Beats for a few months now, that we thought recession was on its way. So, I'm sure you've probably heard, if you follow me, that I feel like there's a bottom that's in. And I've seen a lot of comments, some of them not so nice. But that's okay. I get it. Market's been rough. A lot of folks, especially folks that just got into the market after the pandemic, we had a lot of new investors get in. And I said one of the problems was that those new investors didn't know what a bear market looked like. It was just buy calls. Oh, we got a dip, buy more calls. The market's going to keep going up. It's going to be this is just a cash register. And the stock market's not a cash register. And when we go into these cyclical bear markets or secular bear markets, the difference being secular meaning long term, usually secular bear markets last a decade. You got lots of ups and downs, but basically for a decade, you don't set new highs. There are no new all-time highs. We get spoiled in these secular bull markets because every time we have a pullback, we just go to another new all-time high. Secular bear markets are brutal. Because they last a long time. We don't see the high again for many, many years. And that can wear on you. The entire asset class is just out of favor for an extended period of time. A cyclical bear market is just a short-term period of stock market weakness within a long-term uptrend. So think back to the trade war, 2018, fourth quarter. We went down 20% on the S&P 500. Very next year, not far into the year, we were back at all-time highs. Think about the pandemic. Folks, when that was hitting, thought it was Great Depression 2.0. It wasn't. We went down for 30 days. We were down 35%. I mean, it was brutal. That and the market crash in 1987 were the only two periods I've ever seen like that. Maybe you could throw in the financial crisis in September, October 2008, when the market tumbled. But that was after a long, steady decline to begin with. But those were probably the three periods, or those are the three periods that really come to mind to me. .com bubble within tech sector, absolutely, no doubt. That would qualify as well. Those have been the worst periods. With the current market that we're in, I'm not seeing 2007 to 2009. I'm not seeing 2000 to 2003. Could I be wrong? Sure. I try to explain this, but being right or wrong is not the goal for me. It's managing risk. So when I start seeing signals that Wall Street is moving into more aggressive areas while the stock market's still going lower, that to me is Wall Street kind of foreshadowing potentially a rise in the S&P 500, just like at the top back in 2021. December, when we had that final thrust on the S&P 500 to the upside. But the entire month of December was led by far by defensive groups. All four defensive groups were the best performing areas. in December. So, and the aggressive groups, technology and consumer discretionary, they went higher. It wasn't that they went down, but if you look beneath the surface and you looked at the rotation, the money was actually moving into defense and more away from the aggressive sectors as we were hitting a high. And that's what you need to be really cautious about and watch. It's not just about whether the S&P 500 is going up or down. It's that rotation that's taking place within the market. You know, Wall Street's got a lot of MBAs that they've hired, and that's their job, is to evaluate the economy, to be able to value these companies, to know when they're great deals and when they're overpriced. And if you follow the charts, and not everything you're hearing in the news and media, if you just follow the charts, they will tell you what Wall Street is doing with their money. And a lot of folks think, well, everything's stacked, you know, against the little guy. It's all about Wall Street. Well, yeah, it is. You know, there's a lot of money at stake. And Wall Street, you know, is going to do their best to make as much as they can, much of it at our expense. So you can sit back and listen to what the media is telling you, or you can watch what Wall Street's doing with their money. And so when I start seeing signals like I saw last week, extreme sentiment, fear, extreme fear, reaching levels where bottoms tend to form. And again, we talked about sentiment at the beginning of the year. It was so bullish. I said, we've got to get sentiment to reset. The only way you go from really bullish sentiment to really bearish sentiment is to have a lot of bad things happen. And I think we can all agree a lot of bad things have happened. Now everyone's very, very bearish. And the thing is, when you get to this level, those who want to sell have sold or are on the verge and just need to be kind of pushed over the edge. And that's what these high sentiment readings do when the market, you know, has the sell-off like it did last week, or like it's had, you know, since the recent high. That's what throws people over the edge and says, that's it, I can't take it anymore, I'm out. And that, unfortunately, is what marks bottoms. So I think that there's a good chance there's a bottom. I'm not saying it's a guarantee. Never would you ever hear me say it's a guarantee. But I do think that the risk, you know, evaluating the market where we were in December, I thought the risk was to the downside. Yeah, we could go higher, but yeah, you really wanted to be careful with everything that was setting up. Now I'm looking at it from the other angle, and I'm saying, okay, now the stock market has sold off. We've discounted a lot of bad stuff. Have we discounted enough? Well, that's up for debate, and I guess we're going to find out. But we've gotten to levels, we've seen rotation now working in opposite fashion, and that's why I think the risk at this point is being short or being in cash. I mean, now, you know, and everybody's different. When I say, you know, there's a risk of being in cash, if you're retired and you can't afford to lose, then cash is still a great option because, like I said, there's no guarantee the market bounces. But I think now that the market has pulled back, I did an article, I think it was over the weekend, and I showed the S&P 500 and the decline right now. And I think of the 14 bear markets since 1950, this one now ranks like right in the middle. I mean, it's like 7th. I don't remember where where it was but it was kind of in the middle. I mean, this is a pretty steep bear market that we're in right now, or it's getting closer and closer to the middle. Anyway, yeah, we're going to get on and talk about the show. I just wanted to kind of give you a quick, you know, just some of my quick thoughts about why I wrote the things I wrote last week, and where I think we are in this process. I think we're in a bottoming process. So that means the bottom could be in. I think it's in, but no guarantees. We're going to kind of find out together as we move forward. Anyhow, this morning, let me just tell you, like I said, futures still up. NASDAQ futures up 190 right now, which is about just a little under 1.7%. Let's go through today's agenda before we kick things off. So I'm going to go through the daily market recap, talking technically, sentiment. I'm going to take a look at sentiment again. I think, you know, I've been doing this a lot, but Sentiment to me is what marks bottoms. It's not the price support level from 7 years ago. As technicians, that's what we like to look at. Well, that was the low then. Listen, when the market is in this kind of a panic state, no one is pulling up their charts and looking for support when they are scared out of their minds. They're just hitting the sell button. And market makers know this. Trust me, they've been there before. They know what happens in these, when the VIX is in the 30s and the equity only put call ratio starts surging up to levels where bottoms tend to be marked. Market makers know what is likely to happen from here. So they're going to be matadors when everyone wants to sell. What do I mean? You ever seen them? You know, the matadors holding up that red cape for the bulls, and then the bulls come and they just pull the cape out of the way. Yeah, that's what the market makers do. They're like, okay, yeah, we got you. We got support. Oops, let's just let that price fall a little bit further. There's no reason for us to buy now. I mean, you're in panic mode. You'll sell at any price. Why should we put our capital to work, you know, at a higher level when we can buy at a lower level? So they, in some ways, do act like matadors. I always call it market makers on vacation. When you get a VIX in the 30s and the equity only put call ratio soaring, market makers are on vacation. They're not putting their capital to work. They're waiting for you to panic and throw that kitchen sink in. They want to see the baby coming out with the bath water, all those things, all those cliches. So anyway, it's important to look at sentiment. So we'll look at sentiment. Then we'll get into the eb.com mailbag. I've been getting a lot of emails, as you can imagine. It's been a rough year. A lot of people have lots of questions. The one thing that is somewhat limited at earnings beats, we can get a lot of stuff done, but the one thing that's limited is my time. And it's really hard to get back to individual questions. I'd love to answer everybody's questions like within 5 minutes, but then everything else I do for our members suffers. So I have to be careful. So I thought what I'd do is maybe start this eb.com mailbag, and I'll try to answer some of our member questions, you know, when we get those, and put them here. So at least try to keep the questions answered as up to date as I can. Anyway, then earnings spotlight and the 3 you must see. Before we get into any of that, let me just run you over to Earnings Beats real quick. If you are new to earningsbeats.com, scroll down, and right here on our homepage, there's a newsletter, free newsletter. Our EB Digest. I publish it 3 times a week, Mondays, Wednesdays, Fridays, normally out by about 8:30 in the morning. Try to get it out about an hour before the market opens. Also takes a name and an email address. There's no credit card required. You can unsubscribe at any time. Make sure you check that out. I like to think of it as our Earnings Beats community. Obviously, our members are extremely important to us. They allow us to do what we do. But just being a part of it, I mean, we do like to try and give back and try and help to educate, and that's our way to do it. So sign up for that if you can. All right, let's talk a little bit about what happened last week to close out the week. Dow Jones Industrial Average finished down 38. S&P 500 was up 8. NASDAQ was up 152. Mid-caps up 20. Small caps up about 8. So on a relative basis, NASDAQ your winner. Now let's keep in mind options expired on Friday. And to be quite honest, I was expecting the market to have a really big end to last week. And when the Fed came out on Wednesday and we saw that big rally into the close, I thought, here we go. This is it. We're going to have a big gap up on Thursday, and rest of the week, look out. Well, the Wednesday closed bullish. When I went to bed on Wednesday night and I looked at futures were up. I think the NASDAQ may have been up 100 futures. I'm thinking, okay, I'm going to wake up and these things are going to be bright green. And I woke up, rolled over, looked at my phone, and I think I saw NASDAQ minus 300. I just kind of rolled back over. I'm like, okay, here we go again. So we had the big gap down on Thursday. We tried to rally a little bit. Didn't really work out too well. Finished down quite a bit on Thursday. And then Friday, we saw this bifurcated action here where money did rotate back into the NASDAQ. Some of the stocks, most of the stocks that had a lot of net in the money put premium the middle of last week held up going into the end of the week. I wouldn't exactly say that they were flying higher. A couple of them did okay. Stocks like Zoom, I think, had a pretty good week. I think CrowdStrike might have come up pretty nice. But others that had a ton like of net put premium, like Amazon, it went up, but it was barely up. Apple just kind of meandered. Microsoft, same thing. I mean, there wasn't this, and the semiconductors got hit. So if there's one caveat to all of this that I would kind of watch this week, the one thing that maybe makes me a little nervous about my calling a bottom is that semiconductors still are not performing great. That's not even the right word. They're not performing well at all. They are underperforming, on the verge of another relative breakdown. So that gives me a little bit of heartache for sure. Communication services from a sector perspective, up 1.4%, discretionary, a little over 1%, technology, just a tad under 1%, real estate up 0.6%. And on the flip side, I always talk about option expiration week as being opposite George week, which is just a Seinfeld reference if you're a Seinfeld fan. And that's where George Costanza just decides, okay, well, actually it was Jerry that suggested, but George is just down on his luck as he always is, never can get anything right in life. And George says, well, if every decision you make is, results in just bad stuff, just every time you come up with a thought, do the opposite. And he starts doing that and his life starts to turn around and things, it was a pretty funny episode. But anyway, that's what option expiration week is all about, in my opinion, because the groups that are doing really well going into option expiration week, if they've got stocks in that area that are heavily traded in the options world, there's a chance that there's a ton of in the money call premium. So it just behooves market makers to bring prices back down in those areas. Not that they'll lose money if they don't. It's just that they can make more money if the prices come down. So mysteriously, a lot of sarcasm there, but mysteriously, these prices tend to drop. Look at energy. I mean, it has been straight down now for about the last 6 or 7 trading days. It might have topped and maybe that's it for energy. I don't know. But I got to believe some of it has to do with options expiration. Because when we provided our list of the NASDAQ 100 and the Dow and all of our portfolio stocks, we gave max pain levels on all of those stocks. It was like 160 stocks. When we did that, the energy names that were on those lists most of them had max pain that was well below the price that we provided to our members on Tuesday of last week. And by Friday, almost all of them were below the max pain. In other words, all that net put premium was wiped out. And that is pretty stunning. But if you follow max pain and you follow us, pretty typical. So anyway, energy, really, really poor day on Friday, down 5.5%. All right, 10-year Treasury yield. Before I get into this, I do want to say that we will have May existing home sales out later today. Expectation there, 5.4 million units. April was 5,610,000 units. So we're expecting a drop. I don't think that's going to come as a huge surprise to anyone with interest rates going up the way they have. But we are still kind of looking a little bit in the rearview mirror, getting the May existing home sales. I mean, here we are toward the latter part of June. But anyway, that report will be out later. Thursday, we get initial jobless claims. Friday, new home sales and consumer sentiment. So this is a pretty light week for economic news. And that's probably good if you're on the bullish side, because the economic news hasn't been very good. So if we don't have any, that by default is good news. So that, I think, will help the market a little bit this week. We're now beyond the Fed. We're beyond both those inflationary reports for May that were released in June. So inflation news, the Fed, some of this I think will settle down a little bit. I think that gives the market an opportunity to rebound. We'll see. But 10-year Treasury yield, there's that high that we saw up into the 340s, nearing 350. We pulled back. This morning, we are a little bit higher on the yield. Doesn't show up on this chart, but right now we've got the 10-year Treasury yield up 3.29, up to 3.29%. So it's up about 5 basis points. Let's take a look. Talking technically, a lot of times I just like to pull up the S&P 500 just to kind of get a sense. I mean, we all know it's been going down. One thing that I would say is different about this latest move down is that we did see some rather sizable gap downs. And that's one thing that we saw back in the pandemic. We saw a lot of gap downs. And when I start seeing gaps, my mind starts thinking manipulation. Because if the market closes or opens where it closed yesterday, then we know, okay, we're kind of just picking up where we left off yesterday. And then, everything, whether we go up or down, is being done during the day. So it's actual buying and selling throughout the day. When we start getting these gap ups and gap downs, it really starts to cloud the picture, in my opinion, as to what's taking place. And a lot of times when we start doing this, I begin looking at each day's open versus the intraday move. Sometimes I'll get a spreadsheet out and start keeping track of it, because a lot of times we go lower and it masks the fact that we're seeing some accumulation because we just see lower prices. In the pandemic, most of the losses that occurred during the pandemic were gaps. Most of it was not intraday selling. It was preying on the fear that was building and waking up to just awful futures. And then maybe the market went down and kind of rallied back. Then the next day, gap down. And then we'd see a big rally, and then we'd gap up the next day, and then we'd see some selling. But it was so hard to visualize on the chart. You just saw prices going down, but you really lost focus of what was truly happening during the trading day. And that's why when I start seeing gap downs, I get a little bit skeptical, if you will. So anyway, we did see some big selling on gaps, and then some red candles as well. So it wasn't just gap down and that's it. I mean, you can see these big red filled candles. That's also distribution. But what was being sold? Obviously, energy was being sold pretty hard. But all the areas of the market went down. Relative strength, though, was starting to favor some of the more aggressive areas, and I think that is a bullish development for equities. The AD line. I mean, look at the AD line. All right, where were we here at the high? Right here. At this peak, we were at a new high. At this peak, we were almost to that high. But prices keep going down, yet the AD line seems to still be suggesting that we've got plenty of folks willing to buy. And most of them are doing it later in the day. That's how you get rising AD lines. In order to get a rising AD line, you got to finish at the midpoint or above in that day's candle. That's all it looks at. And then the volume is the multiplier. So you get a percentage based on where you finished within. So these days right here, you see where we finished on the lows, all of the volume would be subtracted from the AD line. Here, even though we finished even for the day, we finished right at the same close. This is actually a plus because we saw it come back up and finish in the upper half. So and there you can see the AD line moving up a little bit. That's the essence of the AD line. It's really simple to kind of visualize. But sometimes, this was developed by Mark Chaikin. And I know in his interpretation, when you see price action going down and the AD line going up, it's like a positive divergence of sorts. And so I use the AD line as a secondary indicator to confirm a lot of times what I'm seeing on the price chart. So I would rather see price action go up and accumulation distribution go up to confirm it. Now, when it stays up while prices are going down, yeah, I think that's an interesting thing. Would I buy it solely based on that? No, I need to see something else. I mean, we do have lower prices. We've got a slightly higher PPO, so we have a positive divergence. When we ultimately bottomed over here with this lower price, we had a higher PPO, and you can see we did rally for a while. So, and even if you draw trend lines, I think we can rally here. I guess that's my point. Is short term, I think we're probably going to rally. All right, next up, sentiment. I just wanted to show you a quick chart on sentiment. The S&P 500 going down, and of course, as it goes down, the equity only put call ratio, this is a 5-day moving average, is going up. This is the reset that I talked about. I look at it on a 253-day moving average. That's where I really like to look at the reset. But you can see it here in this chart that as the market's been going down, we're getting more fearful. Higher CPCE means more fear. Now, the other thing I want you to just look at is that when we roll over on these tops, I mean, you could go back to almost all of these, this one, this one, this one. When you roll over on a top, price is bottom. You roll over on the top, price is bottom. You roll over on the top, price is bottom. You roll over on this top, price is bottom. There was one that didn't work very well. It was this one right here. Got a little bit of a pop, rolled over, but from here, we really didn't rally much, just kind of sideways. But all the others, pretty much when we have rolled over, we've had some sort of a rally, even if it's just short-lived, 3, 4, 5, maybe even 10%, 12%, but something. This is from an elevated level and we're just rolling over. So does this mean this is going to keep going down? This is going to turn higher? Odds would say probably. So I would be looking for a short-term bottom, even if I wasn't calling a long-term bottom, just because of the sentiment. I think that's important to realize. All right, next up, this is a mailbag. So a question came in from a member and said, Tom, don't we need a VIX in the 40s or maybe 50 to mark a bottom? And so down here at the bottom, this is a 15-year weekly chart. And I have the VIX set up to candlesticks so that you can see the intra-week highs. And when I go back and look at the lows, first of all, this is like a generational low. This was a secular bear market low. I think that was really an important low that was established. And the VIX was off the charts. We got up to 90 back in 2008, not as high in when we put the ultimate low in. So I guess one lesson to learn here is you don't necessarily have to have a higher VIX. It's an elevated VIX. We were at 50 when we ultimately marked the bottom there, but it was much lower than the prior VIX reading. Here in 2011, when we put in another low just below the prior lows, the VIX didn't go up above that prior. Here, back in 2010, prices went lower. The VIX had already hit a high level. The next VIX came in lower. Here, we got a VIX reading up into the 50s in 2015. When we ultimately bottomed slightly lower, the VIX was around 30. Here, the trade war, the low, ultimately marked with a VIX in the 30s. Then the pandemic obviously triggered a lot of selling. But here we are, and the VIX has been now well in the 30s. Lower prices, slightly lower VIX, but that's, again, we've seen that in the past. I think the VIX is high enough to bottom. Would it be better if it went higher? Sure, it would be better, but I still think it's high enough to bottom. All right, earnings spotlight. Lennar came out, not a whole lot of earnings coming out this week. FedEx is later in the week, but Lennar pre-market, let me just give you an update there, what it's doing. It's up over 2% this morning. It's been beaten down, probably a little relief rally here. And now the three you must see to wrap up. Just going to give you three charts, three industry group charts that I think look very interesting. One, recreational services had a great day on Friday, but don't lose sight of how bad this chart is. Look at the relative weakness on recreational services. So some of those cruise lines are getting an oversold bounce. I don't know that this is the time necessarily to go jumping in there. Next up is renewable energy. I actually like renewable energy. We're holding that prior low from May, even though the market hasn't. So we're starting to see some relative strength here. A breakout above 175 would be incredibly bullish, but we got some work to do to get there. And then the last one I had for you is the airlines. Airlines went a little bit below this prior low. Relative strength is weakening, but not down to the March level. So I'm seeing a little bit more sideways. I'm just neutral on this group relative to the S&P. All right, that's it for me. Appreciate you tuning in. Hopefully I was able to explain some things about how I'm looking at the market, and we'll see how we go. Futures are pulling back a little bit from earlier. NAS still up about 1.4%, 160 points as we get closer to the market open. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.